Imagine waking up one day to find your safe, well-diversified S&P 500 portfolio down 30%. You did everything right. You didn't pile all your money into crypto. You were diversified, just like Warren Buffett said you should be.
If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. So I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs.
How could this happen? Let's take a look at the ticking time bomb at the heart of your portfolio. The concentration of stocks in the S&P 500 is ridiculously high. For the past 35 years, the top 10 stocks in the S&P 500 have averaged a 20% weight. During the dot-com bubble, this figure reached its peak at 25%. Currently, it's at 32%. What are the stocks that dominate the S&P 500, you ask? These are the infamous Magnificent Seven: Apple, Amazon, Google, Meta, Microsoft, Nvidia, and Tesla. These stocks have completely dominated stock performance over the past decade. Since the S&P 500 is cap-weighted, these stocks have become ever larger parts of the index. Here are some crazy stats to compare the size of these juggernauts. The market cap of these 7 stocks is now greater than that of the entire stock markets of Canada, Japan, and the UK combined. In 2023 alone, these companies grew their total value by an insane $5.4 trillion. That's more than the combined market value of Germany, France, Italy, and Spain, the 4 biggest Eurozone economies. In both the dot-com bubble and the current period, the leading companies in the index were in the technology and internet sectors. Yet this is where the similarities between the two periods cease. The Magnificent Seven are not paper tigers. In contrast to the tech bubble era, these companies are flush with cash, highly profitable, and have growth rates and margins that are twice as high as the rest of the market. Their current valuations are backed by solid fundamentals, and their stock prices align well with their historical valuations. I'm going to tell you a little bit about each of the Magnificent Seven. See if you can spot the common theme. Microsoft invested $13 billion into OpenAI. The revolt at OpenAI, involving the sudden dismissal of Rockstar CEO Sam Altman, was a threat to that investment. Under CEO Satya Nadella's adept handling, the partnership with OpenAI was strengthened, with Altman reinstated, leveraging OpenAI's leading AI technologies to potentially generate significant revenues through applications like Office 365 Copilot, and expanding into sectors like CRM and cybersecurity. Amazon's cloud business, a key driver of operating income, has faced challenges recently, but this is expected to be short-lived, largely due to the potential of generative AI. Despite initially lagging in this technology, Amazon has made significant strides, as showcased at the AWS reInvent conference. With Bedrock, its AI platform, and the introduction of the Q chatbot, Amazon is positioning AWS to win through the rapid expansion of generative AI by its customers. NVIDIA CEO Jensen Huang's substantial investment in AI, predicting that GPUs would be central to this technology, has proven to be incredibly successful. Beyond being a chip manufacturer, NVIDIA has developed a comprehensive technology platform for advanced AI applications, including networking and a software system called CUDA, creating a strong competitive advantage as AI continues to expand. Meta, or the company formerly known as Facebook, experienced a resurgence in growth driven by the success of Instagram Reels and enhancements in advertising through AI. Given just how many people use Meta products, that could lead to a huge jump in revenue. Concurrently, Meta's investments in its large language model, Llama 2, has positioned it as a leading choice for open source platforms. Apple, despite facing a slowdown in smartphone sales due to market maturity, is a formidable player, thanks to its substantial customer base and profitable service sector, including Apple TV and music. Additionally, Apple's foray into AI with the introduction of MLX, an open source framework for Apple Silicon designed to facilitate AI project development, shows promising potential in competing with rival systems. Alphabet's Google has experienced a resurgence in its primary search and advertising sectors, yet concerns linger over its delayed entry into commercializing generative AI, despite being a pioneer in its research. To compensate, Google is rapidly advancing with its latest state-of-the-art model, Gemini, integrating it across various applications and developing new AI-driven products in areas like code development, cybersecurity, and healthcare, potentially unlocking new avenues for growth. Despite significant investments in EVs by rivals like Ford and General Motors, Tesla maintains its lead in this category, bolstered by an advanced production infrastructure and extensive charging network. Tesla's strategy to spark a price war through operational efficiencies gain from scale and will benefit consumers and maintain competitive pressure, while Tesla's real profit margins are expected to arise from value-added services like self-driving software. One of the primary moats Tesla has is the enormous amount of user data they have collected from being the early mover in self-driving. They have a treasure trove of data they can deploy to train the best AI autonomous driving models. Pause the video and see if you identify the common theme to these stocks. If you guessed AI, you guessed correctly. All of these companies are investing heavily into AI transformation. AI is an enormous opportunity, but there's a threat lurking in this space. It's not Skynet, although if you believe Elon Musk, that's a problem too. Heavy concentration of the S&P 500 in tech has in the past shown that the index can be vulnerable to tail risk. As the tech industry has become increasingly globalized, this concentration not only heightens the risk of market fluctuations, but also makes the market more vulnerable to international political events. That's why you should care about Taiwan. Taiwan is home to Taiwan Semiconductor Manufacturing Company, TSMC. There is a significant correlation between the Magnificent Seven stocks and TSMC's stock price. It has been growing and now stands at a record 66%. Taiwanese firms dominate the semiconductor manufacturing industry with a 68% market share. The Taiwan Semiconductor Manufacturing Company stands out as the largest contract chip maker globally, producing about 90% of the advanced semiconductors used in AI. TSMC's capability to produce such sophisticated chips at scale is unmatched by any other company. That's why it's very relevant that Taiwan just went to the polls on Sunday, January 14th, and elected Lai Ching-te as president.
Taiwan elected Lai Ching-te as its new president. He vowed to safeguard the island's de facto independence from China. Meanwhile, China is criticizing the U.S. and other nations for congratulating the new leader.
Lai's recent election as Taiwan's president marks a historic moment, granting the DPP a third consecutive term in power, a first for Taiwan. His victory is particularly significant given the context of escalating threats from China, which claims Taiwan as its territory and has increased diplomatic and military pressure on the island. Lai's stance on Taiwan's independence has evolved from openly supporting it to now maintaining the status quo without pushing for formal independence. This position, similar to his predecessor, has made Beijing hostile towards him. This is relevant given that China relies on Taiwan for chips too. Some believe China's difficulty in matching Taiwan's semiconductor success might prompt a forceful takeover of Taiwan's foundries. However, China's long-standing unification goal predates its chip-making needs. China likely couldn't operate Taiwan's factories, which depend on U.S. and allied technology. Others argue China's dependence on Taiwanese chips reduces conflict likelihood, as disruption would harm China's economy. But China's unification drive might supersede economic concerns. Conflict in Taiwan could disastrously impact the global economy, disrupting supply chains and affecting major companies worldwide. What can you do? The economic risks of conflict in the Taiwan Strait highlight the need for the U.S. to bolster its semiconductor industry. The CHIPS and Science Act, allocating $52.7 billion, aims to enhance domestic semiconductor production and R&D. Major U.S. companies, including Intel and Micron, are investing heavily in local manufacturing, complemented by TSMC's significant investment in Arizona. However, success requires supportive policies like immigration reform, increased R&D funding, and a robust supplier ecosystem. Despite efforts to reshore manufacturing, the U.S. will still depend on Taiwan for advanced semiconductors. AI is a huge opportunity, but it's making the biggest stocks in the world a bet on a single technology that concentrates risk and exposes markets to black swan events. Everything is connected. We are all connected. The small decisions we make today could have big consequences in the future. As you prepare to vote in this year's elections, consider the importance of maintaining peace in the Taiwan Strait and America's role in semiconductor manufacturing. Your vote can influence policies that shape the future of global technology, economic stability, and international relations. Keep in mind the need for policies that support technology advancement and international stability. Choose candidates who understand and value these issues. If you like this type of content, please like and subscribe. It costs you nothing and it means a lot to me. Please let me know what other topics you would like me to cover by leaving a comment.